Welcome and good afternoon. We appreciate you taking the time out of your busy day for us to share some thoughts with you about the upcoming election. There is some anxiety out there about what may happen come November, and how it may relate to your investment portfolio. So we thought it would be an ideal time to look at U.S. markets from a historical perspective with regards to presidential elections. I'm Jim Degatano.
And I'm Chrissy Ward.
We are with Diamond. We'll both be presenting the webinar today. At the end of the presentation, we will open up for questions using your chat function. And just another reminder, if you can keep yourself muted until the end of the presentation, we appreciate that. I am keenly aware that the most terrifying words in the English language, as I quote, "I'm from the government, I'm here to help." Fortunately, neither Chrissy or I are sponsored by the government to offer this webinar, so let's begin. Essentially, there are three basic or likely outcomes that can occur from the election. The first one would be Trump wins and the current congressional makeup stays the same. This outcome, we pretty much know what the game plan is because it has been playing out. Energy policy that's supportive of the existing framework, with Trump potentially offering more friendly policies towards fracking and offshore drilling, lower regulation, no rollbacks of the tax cuts, with no expectation to change the corporate tax structure for at least 2 more years. If President Trump wins, we will most likely see the Senate stay Republican. So we'll move on to the other two options for a Biden win. The first one would be if Biden wins and the current Congress makeup stays the same. Clean energy will be a focus with a plan to expedite the transition to low carbon vehicles, increased spending in the battery and energy storage technology over the next 5 years, emission reduction policies, plan to go carbon free by 2035 would most likely be in the agenda, as well as the potential for higher corporate taxes in 2022. If Biden wins and the Senate goes Democrat, that would be the third likely outcome. That leaves a full Democratic sweep. This is the scenario that we notice most investors tend to be most concerned about because of the uncertainty and most potential for change. There is clearly a possibility of major changes to tax law in this scenario. That would not happen overnight, though, but it could reduce corporate profitability and also how we plan at the individual level for all of you, all of our clients. We anticipate an infrastructure bill to be imminent in this scenario with the most impact in the following areas. Increased risk for gas and oil pipelines, could be positive for electric utilities, could be positive for transportation and logistics companies that could see some high upside with government dollars heading into this sector. Water utilities, we think is a good sector, as well as communications as a potential large investment in broadband internet across rural areas, across rural areas that we think would probably boost U.S. tower companies.
Okay, let's take a look and see how the Dow Jones Industrial Average has moved during election years, specifically the differences in the movements depending on the election results. I know this chart has a lot of data, but for today, we'll focus on the black and the red lines. The red lines because the 20 situation is if the incumbent Republican either wins or loses. Phew, now that we've hopefully understand the lines, let's look at what the chart is trying to illustrate. First, the bolded black line serves as our reference point for the Dow's average performance between 1900 and 2016 on a month-to-month basis during an election year. Now, the solid red line depicts the Dow's performance on average over that same time period during an election year if the incumbent Republican Party wins the election. The dashed red line shows the same data if the incumbent Republican Party loses the election. All right, let me just point to a place on the chart. Right here is right around the election date. Here on November on the dashed red line and on the solid red line right up here. that, as I said, that's the election date, and assumes that the dashed red line assumes that the incumbent Republican does not win the election. The Dow does finish the year higher than it was on election day in that case. Now let's compare this with that solid red line at the top. That is assuming that the incumbent Republic won. And again, historically, the index, that's the Dow Jones, year-end rally was stronger with those specific election results.
We all remember the craziness of the year 2000 election and what happened in Florida. So what if we had a similar repeat of those results? Well, this chart shows us we do notice around a 6% drop in the Dow.
Yeah, I know it is. She said we would just see pictures and they would be talking in the background. I can't read that from here. Can you tell me what that says?
Talking owner.
If you could please mute, that would be helpful.
Owner, that's us.
Hey, Jim.
Yes.
You might be able to override and mute them.
Yeah, we're trying to. We're trying to find out. There we go.
There we go. We just muted
All right,
them.
thank you.
Okay. This is your favorite client, Tim Keys, by the way.
Hey, thanks, Tim. Appreciate it.
Just as a reminder, real quick, I'm sorry to interrupt, Jim. Don't unclick your own mute. You have the override ability over us, but we've muted you all. Please don't unmute yourselves. Thank you.
No worries. So if you take a look here, we did notice around a 6% drop in the Dow while Gore challenged the election. But I would imagine there's probably an increase in many Americans' blood pressure during that same period. What's more important, though, to note is that though the markets did rebound once things settled, and you can also see from the graph that the drop wasn't anything greater than what we saw throughout the year. So if you actually take a look early in the year of what I'm highlighting, and then, of course, running up to the election, you saw much bigger drops than what actually happened while the election results were being challenged.
So the S&P 500, which is another index, delivered an average annual return of approximately 11% over the past 75 years through both Democratic and Republican administrations. During that time, also, the U.S. economy expanded around 3%. Here's what's really interesting. So if I were to draw a line right across where the 11% is, so right about if I drew it straight across here, right to above Johnson and Kennedy, a total of 10 presidents over the last 63 years were in office during those periods of strong growth. And here's what's more important. 5 of them were Republicans and 5 were Democrats. The stock market's return was negative only during presidential administrations when the country was in a financial crisis, as 2008 under George Bush, or experiencing a stagflationary spiral as seen in 1973 under Nixon. Bottom line, neither party can lay claim to superior economic or financial market performance.
To further add on Chrissy's last statement that neither party can lay claim to superior financial market performance, we look back since 1950 in this chart to 2019. And this suggests that the best performing market during the period was a Democratic president and a Republican Congress. So what we're going to do is we're going to look at the 3 potential outcomes from the election, and we see what this provides. So the first outcome is President Trump is reelected with the same split Congress. And you can see by the chart that has averaged a 17.9% annual return. Outcome potential 2 is if Biden is elected with the same split Congress makeup. And that has averaged 15.9% annual return. The third option is if Biden is elected and the Senate turns Democrat, which would be Democratic president and complete Democratic Congress, and that has averaged 13.2% return. Now, you might look at the returns and those may seem high, but if you look further back in time, it brings the returns lower once you include the Great Depression and many other years. But This chart really does suggest, from our perspective, the beauty of our system of checks and balances. So with a mix of political makeup in the White House and Congress, that's actually what's best for investors. We might fight and argue, but eventually it's the compromise between both parties that moves the markets the highest. This actually reminds me of the saying that politicians in diapers have one thing in common. They should both be changed regularly and for the same reason.
Love it. So, spoiler alert, your best strategy is to stay off the sidelines. Here's an example, of course, that's close to my heart. A basketball player has a much better chance of scoring during a game when he's actually in the game, even when he misses over 50% of the shots. The difference, he wasn't on the bench, but he was in the game. Remember, it's time, not timing in your investment journey. This chart shows 3 different strategies taken by 3 separate investors. The first, with the darker blue, this investor decided to stay the course and not be swayed by the media, political rhetoric flying back and forth, or even those constant phone calls that continue to come in during election year. And he invested $10,000 on January 1st of that election year. The ending value, on average over a 4-year holding period, was almost $16,000. The second investor chose to continue to make consistent contributions, similar to a strategy in a 401k plan. If that investor were to invest $1,000 for the first 10 months of the election year, the ending value would have been slightly higher than the first scenario, ending that 4-year holding period at $15,729. The third investor, well, he decided that burying the money in the backyard was a better idea than following his established plan. On January 1st, he decided to dig up the money and put it back into the market after he knew the election results. He finished that same time period that we were looking at with just shy of $15,000. Now, here's a little special note about 2020, the year 2020, and the risk of sitting on the sidelines. Don't forget that the interest rate environment that we are in is historically low, and sitting on the sidelines could really derail some of your long-term investments.
Yeah, it should also be noted, this is an analysis from 22 election cycles, going the whole way back from 1932. So there's a lot of data in this very simple chart. You also used a very great basketball example, Chrissy. I should make a note. Her son is one of the area's best 3-point shooters. He is hoping to break some school records this season. Hopefully they have a season. Good luck to Matthew Ward if you see his name in the papers. That is Chrissy's son.
Thank you so much.
This chart's a really interesting one, I think. And one of the biggest fears that we tend to see among investors, frankly, is that a progressive candidate might radically re-engineer the economy. Remember, all presidents need control of Congress as well to run their agenda. So our system of checks and balances resulted in the last 2 presidents getting 1 signature achievement before losing the House. So let's take a look at that. So despite concerns about major governmental policy changes, business investment and government spending have been remarkably consistent as a percent of GDP. If you look at that chart above, since 1957. And even through the enactment of major government spending programs, you look at the bottom and what you see is the S&P 500 has still achieved returns of an average a little over 10%. So in the chart here, you look, that includes in LBJ's Great Society with Medicare and Medicaid back in the mid 60s. You're looking at Reagan and his Economic Recovery Act in the early 80s, following on to Clinton in the mid 90s with the Personal Responsibility and Work Opportunity Act, and then Obamacare with the Affordable Care Act in 2010.
Four different but memorable presidents in history right here on this slide. So if I were to ask you what one thing you remembered about each of these presidents, you might say the long lines at the pumps under Carter, the trickle-down theory under Reagan, more recently, the creation of Obamacare during Obama's presidency, and in the last 4 years during President Trump's tenure, well, we all could remember something different. But what we don't remember of each of these presidents is that Jimmy Carter presided over significant job growth. Under President Reagan, income for those in the 50th percentile of the population, that's ranked by income, grew by almost 20%. During Obama's presidency, despite concerns that his policies would be massively inflationary, the U.S. had one of the longest disinflationary environments on record. Under President Trump, capital expenditures have been below their historical growth rate, even in the aftermath of a large corporate tax cut. Clearly, history is often remembered differently than the actual data. President Reagan said it best of a president, "Politics is not a bad profession. If you succeed, there are many rewards. If you disgrace yourself, you can always write a book."
So let's take a look at the most recent signature legislation from the last two presidents. Predictions and assessments about the ultimate impact of legislation are often far removed from the actual results. As is common with most policies, those in favor overhype them, those against tend to suggest the complete downfall of our society. So I noticed the same behavior with sports fans and their passion, but I digress here. In 2010, Obama passed the Patient Protection and Affordable Care Act, known as Obamacare. For instance, it was predicted that the Affordable Care Act would destroy small business hiring. But if you look at the chart, since 2010, 8.6 million jobs have been added in this sector up until the end of 2019. Now, one could argue the GOP took majority in Congress in 2010, and that was when the jobs growth started, or one could take the perspective that Obamacare was still in effect during that GOP-controlled Congress, and the destruction of jobs just did not happen as suggested. Similarly, the Tax Cut and Jobs Act under Trump was intended to unlock capital expenditures, but it has thus far failed to bring an acceleration in business investment as originally anticipated. The explanation may be that a potential decline was underway in 2018, but this law actually changed its course and would have continued to fare well if not for the lost confidence in 2019 amid the uncertainty over trade and Democrats winning majority over Congress. It could also be argued that it was only a short-term fix for capital investment, and the economic cycle would eventually run its course anyways. So in both cases, presidents lost single-party rule as the House of Representatives turned over to the opposition party after their signature accomplishment was enacted.
We've always resisted making market calls based on the results of presidential elections. Why? Because such calls rarely get it right. And to be honest, my crystal ball is a little cloudy lately. The past 10 years provide an interesting case study. Two very different presidents have had similar market performance. Growth stocks have continued their spectacular run against value as companies that find ways to grow revenue faster than the headline rate of economic growth are rewarded. This is a far cry from what President Trump's policies were expected to do, which was to accelerate growth, thereby raising real yields, steepening the yield curve, and unlocking value in the market. But value stocks didn't receive the catalyst they needed to outperform. Conventional narratives are often wrong on candidates' stated policies. Remember the end of healthcare stocks in 2008? The healthcare sector returned 15.31% annualized, just below the 15.99% return of the S&P 500 index, while President Obama was in office. The U.S. 10-year yield has been lower during President Trump's term than it was during President Obama's.
For all the focus put on the executive branch. We would argue here that it's actually monetary policy that matters more. The old adage holds true: do not fight the Fed. Currently, the Fed is providing policy support, but they don't intend to increase rates meaningfully at all in the next few years. In fact, 2 weeks ago, the Fed also changed their policy from a 2% target inflation to 2% average inflation. This may just sound like words to you, but this is a big deal, as it gives the Fed much greater latitude with policy and greater acceptance for inflationary policy. In fact, the Chicago Fed President Charles Evans just said that policymakers need to have an in it to win it attitude toward our inflation objective. In other words, rates need to be pegged to zero or almost zero for a long, long time. So as a result of this, we would expect the current environment to remain relatively benign for stocks and the yield curve to steepen modestly. So historically, presidents have been hurt or helped by monetary policy conditions. For instance, Presidents Reagan and Clinton benefited from a consistently falling interest rate during the Great Moderation. Both Presidents George H.W. and his son George W. were hurt by Fed tightening and an inverted yield curve with a recession. President Obama benefited from a very benign rate environment, maybe a brief moment back in 2015-16 during his term, but other than that, very benign. And President Trump, unfortunately, was the recipient of tighter policy during his first 2 years here before COVID, and then the rates dropping. So markets have done very well during prior periods of easing financial conditions, which we expect to have this easy condition for a while.
Okay, there we go. All right, sorry about that. Investors don't have to love what is going on in Washington, D.C. to prosper in the markets. Some of the best returns in the markets actually came when the presidential approval rating was in the low range between 36 and 50%. Those returns were over 15% and actually happened almost 37% of the time. What that means is the market had delivered some of its best returns during periods when half or more of the country didn't approve of the job the current administration was doing. Even with this data, it's still hard to discern any direct relationship between a president's popularity and the health of the U.S. economy and the performance of financial markets.
Please note, Chrissy was talking about the president's approval rating, not your financial advisor's approval rating. I truly, ours is much better than what that prior slide showed. Contention has always been a part of our political process. In fact, some of the worst incidences of press-facilitated slander against national heroes like Thomas Jefferson and even George Washington himself induced these men to be frustrated with the free press. One of the most infamous duels, actually, in American history was the result of a political disagreement. On the cliffs of Weehawken in 1804, Alexander Hamilton, the former U.S. Treasury Secretary, fought with Aaron Burr, then sitting Vice President of the United States, which ultimately led to the death of Mr. Hamilton. So from our perspective, where we're sitting, as long as Vice President Pence isn't fighting any duels, we're actually maintaining a higher level of political discourse today.
So like no other, right? The number of times I have heard that this election is like no other, well, actually, my answer is you're right. They're all like no other. Here, I know we don't remember this election, but here's two different campaign ads I thought you would be interested to see. The one on the left is John Adams campaigning that a vote for Thomas Jefferson was one to welcome murder, robbery, incest, and adultery throughout the land. He also warned, are you prepared to see our dwellings in flames, female chastity violated, or children writhing on the pike? And On the other side of the screen, Thomas Jefferson campaigned that John Adams is actually busy importing mistresses from Europe or trying to marry one of his sons to a daughter of King George. He insisted that John Adams was a hideous, hermaphrodactyl character, with neither the force or firmness of a man nor the gentleness and sensibility of a woman. Government will always be government, and politics will always be politics as well, no matter what the year is. Well, to quote President Reagan again, he said, government's view of the economy could be summed up in a few short phrases. If it moves, tax it. If it keeps moving, regulate it. And if it stops moving, subsidize it.
Nice quote, Chrissy. As we close here, do we have a concluding prediction for the election or the markets? Well, we're going to withhold our opinion on who wins and let the American people decide who should reside in the White House come January. But a couple things to watch. And one is the S&P returns 3 months prior to the presidential election. In the past, it has been a good predictor. For 20 out of the last 23 elections, the winner could have been predicted based on the direction of the stock market 90 days prior to the election. So if we go back and look and say, hey, August 3rd, the S&P was 3294. As of this morning, it went over 3,400. So if markets continue to go up, well, that could suggest of President Trump's reelection. But again, we're still weeks away from voting, and there might already be some data that suggests, based on polls, that Biden is in the lead. And in fact, if you want to go to the one of the oldest forms of understanding percentages and who's expected to win or not, take a look at the sports books. And an indicator of who may win could be foretold by looking at the odds that Vegas has right now, which is a 62% implied probability that Biden will win come November. Regardless, though, of what that looks like, it may not be the case this election. It may turn out into just a simple referendum on the government's response to COVID and whether you believe or our American public believes the government's done a good job or has not done a good job of the response with the virus. I would not let your favorite election indicators, though, or the ultimate result disrupt your financial plan. A few years back, the entrepreneur Mark Cuban, I remember making a prediction that the stock market would tank if Donald Trump won the 2016 election. Before that, economist Michael Boskin believed that President Obama's policies were killing the Dow. And so the dire predictions of disappointed voters tend to not come true. So we thank you for listening today. What we'd like to do is open it up to any questions for Chrissy and I to maybe add some color or comment on if you have any questions. So if you'd like to ask anything, we do have some people on the call. It might be easier for you to just go ahead and use your chat feature to go ahead and ask a question. Or if no one is speaking and you want to unmute and speak, that is fine too. I don't see anyone coming through chat. So anybody want to ask a question?
I don't think so. It doesn't look like looks like everybody must have gotten all the information they needed and no questions. Okay, wait, we've got one right there.
Okay, no questions. Thanks, Chuck. Thanks, Kim. All right. Well, we'll just stay on here for another minute or so in case someone has a question. If not, feel free to log out, and we wish all of you a great day. And
thanks so much for being
voting
on today. Absolutely. Happy voting. Thank you.
All right, it looks like we didn't have any questions. But again, thank you all to listening. If you do have any questions, feel free to reach out to Chrissy or myself. We'd be glad to answer for you. Have a great day.